Let's get into this major topic called the cash flow analysis. In this topic, we'll be understanding how cash flows are very important, how cash flows should be classified and analyzed to understand the real position of the company or say business entity. Okay. Now, to understand the effect of cash flows, let's have a look at some numbers. Let's say a business entity is making a sales of 100 crore and its expenses are 60 crore and its profit is 40 crore. So now if I ask you a question that what could be the cash generated by this unit? If I ask you a question that what could be the cash generated by this unit because they've made a sales of 100, incurred expenses of 60, their profit is 40. I mean, I can expect three different answers. Let me see whether I have it on the screen. You may give me three different answers for cash generation. Number one, you can say that cash is exactly equal to profit. I mean, the cash generated by this business unit is going to be exactly equal to profit, in which case it will be 40 crore. Or you can also say that a cash can be greater than 40 crore. Or you can also say that cash can be less than 40 crore. So basically we have three scenarios. That is, if I ask you what is going to be the cash generation, you can say it may be equal to 40 crore or it can be greater or it can be less. And why you could not say, I mean, clearly as to what is the cash that is generated by looking at this income statement, which communicates what is the profit generated. The answer is our financial statements, the income statement, the balance sheet follows the accounting conventions policies and it provides for various non-cash items as well. Okay, the profit which you derive, I mean, for considering the profit, you have to include various incomes, various expenses, but various incomes and expenses which does not have any inflow or outflow of cash will also be included. So the profit what you arrive will not exactly reflect what is the cash generated in the business. So this appreciation is very, very critical. Now, so the scenario what we are looking at is cash can be equal to 40 or cash can be greater than 40 or cash can be less than 40. Now, when cash generation can be equal to 40, follow me very closely. If you have made a sales of 100 crore and if you have realized all your sales, no customer is pending payment, if you have realized all your sales and if you have incurred expenses of 60 crore and if you have paid all your expenses, then your profit will match cash generation, in which cash will be equal to profit, that is going to be 40 crore. But you can come across a situation where you may not realize all your sales, whereas you may pay all your expenses, or you may realize all your sales, you may not pay all your expenses, or you may realize only part of your sales and you may pay only part of your expenses. So in all these circumstances, your cash generation will not match with profit. Okay, let's see. I'm taking this scenario where cash can be greater than 40 crore. How? Sales made is 100 crore and I'm realizing entire 100 crore, whereas expenses paid is only 30 crore. Expenses incurred is 60, but what is paid is only 30. So what is going to be the cash position? It is 70 crore. Cash position is 70 crore. Look at here. Profit is 40, whereas cash position is 70. Why it is 70? Because another 30 crore of cash not yet paid. Okay, so this is a scenario where your cash can be greater than the profit. Your cash generation will be greater than the profit of 40 crore. Okay, so we can also have a scenario where your cash that is generated can be less than profit. How? Let's say the sales that is realized is only 70 crore. What is the sales you have made? 100 crore. What is realized? It is only 70 crore. So you are yet to realize 30 crore. But what is the payment you have made? Expenses paid are 60 crore. What is realized is only 70 crore. What you have paid is what you have paid is entire 60 crore. So what is the cash position? Your cash position is 10 crore. So this is a scenario where your cash generation is less than profit. If you look at your income statement, you are making profit. But what is your cash? Your cash is only 10. But look at here. Your profit is only 40, but your cash generation is 70 crore. So understand this significance. Your income statement will communicate profit, but that profit is not equal to cash. Cash generation is not at all linked with your profit. Cash generation is not at all linked with your profit. It is linked with your realizations. It is linked with your payments. To put it rightly, it is linked with your inflows. It is linked with your outflows. So here we have seen that cash is greater than profit, that is 70 crore. And here we have seen that cash is less than profit, that is 10 crore. But this situation will not remain long. It is possible that here, whatever the cash you have as 70 crore can come below, even below this profit. And here it is possible that whatever you are seeing as a cash can go even above the profit. So what are the possible circumstances in which this cash can come down or this cash can go up? So generally, when I raise these kind of questions, the general response from students is they say that maybe if they pay off the remaining expenses, the cash balance can come down. I agree. But what is the remaining expense? Total expense is 60. What is paid is 30. What is remaining? Remaining is 30. So if you pay another 30, this 70 becomes 40. Okay, so in that case it is matching with the profit. But what I'm saying is you can face a scenario where your cash balance will come down even below 40, and similarly here your cash balance can go above 40. So here also I used to get a feedback saying that if the company realizes its pending sales, what is the pending sales? They have realized 70. How much they are yet to realize? Only another 30. If they realize that 30, then cash position will become 10 plus 30, it's going to be 40. But my question is when it will go beyond 40. So for that we have to come out of the cartel. We always think that cash generation is related to these two items. That is incomes and expenses, and the answer is absolute no. Your cash generation or your cash consumption is not confined to your incomes and expense. It is also influenced by your assets and liabilities, right? Think about your balance sheet. Your balance sheet has got a major role. Your money, the money that is coming into the business is not only going to come through sales, it is also going to come through your capital. It is going to come through the bank loans. It is going to come through debentures. Okay, and the money is not only going to go out of the business for expenses, but it will also go out for creating assets. It will also go out for repaying loans. It will also go out for redeeming your debentures, preferences, or say buying back your equity. So all these have to be understood. Okay, so that's why cash flow plays very significant role. Your financial statement, balance sheet, income statement per se will not communicate what is the exact cash flow movement. If you want to understand the exact cash flow movement, you have to go into the next statement called cash flow statement. Now let me give you some more numbers to understand how this 70 can come below 40 and how this 10 can go above 40. Let's see. Scenarios where they can come below or go above. Let's say this firm has got a loan of 40 crore, and if they are going to repay that 40, what will happen to your balance? 70 minus 40, it is 30. It is very well below 40, right? And let's say they are purchasing a machinery and it is 20. What is the cash balance? 70. Loan repaid 40, machinery purchase 20. So what is the position? Position now is 10 crore, right? So let me take the position. It is 10 crore. Cash position is 10 crore. This is what I told you. Cash balance can come below 40 crore. It has come below 40 crore. It has come down to 10 crore. Understand, it has come down not because of the incomes or expenses, but it has come down because of the items that are appearing on the liability side and asset side of the balance sheet. So come out of the cartel. Okay, think beyond. Okay, so that's the scenario when your cash is less than 70 crore. And here we can have examples where the cash balance can go above 10 crore. See, maybe if a company raises funds by way of debenture, money is coming in. It is not coming in through income. It is rather coming in through liability. It's 30. And say they are selling an asset. They are selling an asset and they are raising 20 crores. So now what's happening? Let's see. The total, and they're also raising equity of 20 crore. So 20, 20, 40, 70. Already they have a cash of 10. So what is the total position now? 80 50 crore. Okay, so understand the cash flows into the business is not only confined to income and expenses but also related with the assets and liabilities. So what this cash flow statement is going to do is it will try to identify the nature of the cash flows. Here we have various sets of cash flows. The cash flow statement will identify the cash flow according to its nature. It means cash flow statement classifies the cash flows under 3 different activities. I am going to show you that. Number 1 is operating activity. Number 2 is investment activity. And number 3 is financing activity. Okay, so cash flow statements basically classifies the cash flows into 3 under operating activity, investment activity and financing activity. Now, what are the cash flows that comes under operating activity? Anything that is related to core income generation or operational activity. So it can be income, it can be expense, but anything that is related to operations of business, that will come under operating activity. Anything that is related to investment nature, say purchase of investments, purchase of fixed assets, sale of investments, sale of fixed assets, or income from investments, all will come under investment activity. Next, financing activity, anything concerned with raising finance for the business, maybe raising equity share capital, raising debentures, raising loans, or repaying loans, repaying debentures, or buying back equity, or paying interest, paying dividend, all will come under financing activity. Okay. Now here we have various sets of activity. We'll try to link them. Number 1, let's say, look at here. Sales realized is 100 crore. Expenses paid are 30 crore, cash generated is 70 crore. Now this 70 crore is absolutely generated from operations because sales is operating activity, expenses are related to operations. So this 70 crore will get classified under operating activity. Next item, loan repaid 40 crore. This is something related with raising finance, but here the money is not coming in, rather going out, but still it will be classified under financing activity because it comes under financing activity. Next, machinery purchased, it's an investment. Whenever the machinery is purchased with an intention to be used in the business, okay, for a longer period of time, then we will classify that under investment activity. Then next item, sale of asset. Sale of asset, that should also come under investment activity. Then equity raised, whether equity raised or equity repaid through buyback, that should come under financing activity. Then look at here, the cash generated from operations, that should come under operating activity. So more or less we have covered everything. So let me summarize. In cash flow statement, we'll have cash flows from operating activities, then cash flows from investment activities, then we'll have cash flows from financing activities. So all the 3 activities, if they are put together, we'll call them as cash generated from operations. Let me put them here. It is called as cash generated during the year. Now with this cash generated during the year, what we'll do is we'll add the opening cash and cash equivalents. Whatever the cash and cash balances available in the beginning, I mean cash and cash equivalents, I'm stressing on a technical term called cash equivalents. So that will be added, and automatically, that is with the cash generated during the year, if we add opening cash and cash equivalents, automatically we should get what is known as closing cash and cash equivalents. Okay, so this is the abridged structure of a cash flow statement. Cash flow statement would give us an idea how much cash has been generated from operating activity, how much has been generated from investment activity, how much has been generated from financing activity. So all the 3 put together would tell us what is the cash generated during the year. Now with this cash generated during the year, if we add opening balance, automatically we should get the closing balance. So this is basically a kind of reconciliation statement, but very critical information is we get to know what is the cash generated from operating activity, whether it is positive or negative. If it is positive, we can be happy about it, but if it is negative, then it's a time to ponder what is the point in running the business and again, but it is not generating positive cash. Okay, so we'll get to know whether it is actually generating positive or negative. Then investment activity, we get to know whether we are investing too much or whether we are getting any returns, or continuously whether we are getting positive inflows by way of selling the investment, then that's not a good sign. So all those hints you will get. Then financing activity, whether you are continuously raising funds or whether you are in a position to repay, all those things you get to know by looking at the cash flow statement. So in the subsequent sessions, we'll be analyzing the cash flow statement and we'll get a complete picture out of it. Thanks for watching this video, and I hope you like this lecture. If you wish to learn more on the areas related to this topic, check our comprehensive course. I have shared the details and link in the description below. Click sign up and enroll. I'll see you inside the course.